Hello, everyone. Thank you so much for checking out this video. Here on Show Style and Spirit, I am Ebony, of course. And from the title of this video, you can see that I'm going to be breaking down the difference between securing a mortgage for a newly built home or getting a construction loan to build a new house. Of course, as you know, I placed a poll on the community tab, and the majority of you said yes to take this deeper dive. So I'm happy to do it. And I do just want to remind you about my upcoming interview with Kiki Jabbar from Love and Marriage Huntsville on Tuesday, May 30th at 9:30 p.m. Eastern Standard Time. Please join me for the interview with the beautiful Kiki. Also, please hit the like button on this video, y'all, and please subscribe to Show Style and Spirit if you have not already done so. Obviously, I do a variety of content, right? I do TV show recaps, like recapping Love and Marriage Huntsville, Belle Collective, The Real Housewives of Atlanta. I also do reality TV star interviews. I interviewed Miss Van from Love and Marriage Huntsville. I also interviewed Dr. Kit from Love and Marriage Huntsville, and as well as others, Winter from Love and Marriage DC. So, and then now we're going to go ahead and, talk about some mortgage lending and get into some real estate. So let's go ahead and jump right on in. So if you are getting a mortgage for a newly built home, this is actually meaning that the builder already has the money to build your home. So essentially, they are the owner of that property or the seller until they sell it to you. So then you would actually go to your bank or an online lender and say, hey, I would like to get pre-approved to buy a home. They pull your credit. They ask you, where do you work? How long have you been there? How much do you have saved up for the down payment? What kind of account is that sitting in? And then they actually run your information through an underwriting system, whether it's for a conventional loan with Fannie Mae and Freddie Mac, or if it's with the government for a government loan like the FHA loan, or if you're a veteran, a VA loan. And then they get a decision. You're going to back up that pre-approval with your documents. And I'm going to get into that, how you qualify, in just a moment. So when you are getting a mortgage for a newly built home, you are actually going to not close on that loan until the home is finished, because that way the mortgage lender can send out an appraiser to your newly built home to confirm that the home is complete, that it's livable, it has working plumbing, the electricity works, there's a roof on the home. And they also, obviously, the appraiser has to confirm the value of that newly built home. Because remember, no lender is going to lend for more than what the home is worth. So let's say the builder says to you, oh yeah, this home that I'm building, it's going to be worth $500,000. And you agree, you can afford a mortgage for a home that's $500K. I would say roughly offhand, depending on the taxes and insurance, that could be between $3,500 and $4,000 a month for a home that's $500K, just a rough estimate. But let's say the home is complete, 9 months later, the appraiser for the lender goes out and appraises the property, and they say, well, based on the historical data of homes of this square footage that have these amenities, this home is actually worth $450,000. So then the lender is going to say, we are not lending any more than $450,000 for this home, and you all have to agree to that. So then your realtors would draft up an addendum to add to the contract that says that the new purchase price is for $450,000, and the seller agrees and here's their signature, and the buyer agrees and here's their signature. All right. And so basically your mortgage is covering the purchase of the home from the builder, because the builder already has the money to build the home. So that's going to be your Pulte Homes, those types of builders that I'm sure you've heard of. So then if you are getting a construction loan, you would get this type of loan and not a mortgage if you are going to build the home yourself. So you're the builder, or you're going to hire people to do it, like the way the Scotts hired McMahon to do the drilling. Anyway, construction loans can be refinanced into conventional mortgages. Obviously, you wouldn't refinance it until the home is complete. And then Marsha, oh my gosh, Marceau and Tish. That was funny how that came out naturally. Marceau and Tish. They would fall under this scenario because had they been approved for a mortgage, then the drilling company wouldn't have had to place a lien on the home because the drilling company would have known that they would have gotten their $60K from the proceeds of the mortgage. Does that make sense? So Marceau and Tish, the way that they're building their home, Scott Manor, they're not securing a mortgage from a lender. They would fall closer under the construction loan bracket. But, you know, apparently either they do not have a construction loan or, you know, they planned on paying for it out of pocket somehow, hence leading to McMahon Drilling placing that lien, just in my opinion. So qualifying for a loan, you know, the qualifications, it helps a lender to determine a person's ability to repay the loan. It's just about maximizing risk, you know, or assessing risk. That's all that it's about. And so these guidelines, they come from, number one, the investors, which again, for FHA and VA loans, that's going to be the federal government. They back government loans. And then for conventional loans, you have investors, Fannie Mae and Freddie Mac. They have their investor guidelines. And then the individual lender that you are going to secure the loan, they may have their lender guidelines, also known as overlays. So as an example of that, let's say, I'm trying to think of an actual guideline from a place where like I've worked before. Okay, so let's say someone is trying to qualify with like child support or alimony. And let's say for a conventional loan, you just have to prove 3 months of receiving the child support or the alimony, like via your bank statements. But let's say a particular lender that you're going through for your loan, maybe they have a guideline that they want to see 6 months. So then you would have to adhere to that 6-month overlay because it's the more conservative of the two. Does that make sense? So then with the hard credit pull and analysis, that means, you know, your mortgage lender is going to see if you have any bankruptcies or foreclosures on your credit report or any judgments like tax liens. You know, then if you have a tax lien, you know, are you under a repayment plan? Well, now I need to see your repayment plan from the IRS. I need to see the most recent 3 months of your bank statement showing that you've been making that payment. Does the credit report show any like child support judgments? You know, because, you know, the federal government will hit you with that if you're not taking care of those babies. And then also, I just want to say, when it comes to bankruptcies and foreclosures, there is life after bankruptcy and foreclosure. Don't let that paint your world. Certainly, you can qualify again. There's just seasoning/waiting periods. And it gets really deep, but basically with conventional loans backed by Fannie Mae and Freddie Mac, then you would be waiting a seasoning of 7 years for the foreclosure. That's where you foreclosed on a home, you walked away from it, stopped paying on it when you still owed on it. And then with the bankruptcy, it depends on the bankruptcy. So a lender looks at Chapter 7 bankruptcies as more severe as like a Chapter 13, because the Chapter 13, they like summarized your debts and you make like a monthly payment, I believe. So then the Chapter 13 is not as severe on your credit as the Chapter 7. So the Chapter 13 has a shorter seasoning period than the Chapter 7. And Chapter 11 is for self-employed people. And then, of course, if you are an employee, you will provide your most recent 30 days worth of pay stubs, your most recent 2 years W-2s. If you are self-employed, you would provide your most recent tax returns. Now, Remember, I mentioned the underwriting system that your loan officer is going to run your information through. It's going to come back with findings, which is a report of what the investor wants in terms of documentation. So the investor may want your most recent 2 years tax returns or your most 1 year. And then when you are self-employed, a lender uses your net income after all deductions. So when a person is self-employed, you may write off your home office. You may write off dinners where you talked business with someone. I'm just giving examples. So I believe, in my opinion, that Tish and Marceau would fall under the self-employed bracket, being reality TV stars. And then obviously they are entrepreneurs, as we've seen on the show. And that is pretty much just a very high level overview of the difference between home mortgages for newly built homes and construction loans. So I definitely wanted to break that down for you. And again, y'all, I have to promote the interview as much as I can. So of course, please join me this coming Tuesday, May 30th at 9:30 p.m. Eastern Standard Time when I converse with Mrs. Kiki Jabbar. I think it's going to be a great conversation. I would love it if you would join me. And again, please hit the like button on this video and please subscribe to Show Style and Spirit. I hope you have an amazing day and an amazing holiday. I'll talk with you soon. Bye-bye.